Hello, my name is Ralph de Haas. I'm the Director of Research at the EBRD, the European Bank for Reconstruction and Development. And today I'll be talking about the role of gender in credit markets. So today I would like to talk about two projects that I've been working on the role of gender in credit markets. Both of these projects use Turkish data. In one case, we created data ourselves, so this is based on a lab in the field experiment that we conducted with a large bank in Turkey. And the second paper uses observational data. So let's start with the first paper. This is a paper about gender discrimination in bank lending. And the idea for this paper was basically inspired by us talking to a large bank in Turkey, to the management of a large bank in Turkey. And we were being told that at least part of the management of that bank thought that their loan officers were discriminating against female loan applicants among small business enterprise applicants. The question was whether there would be a rigorous way to find out whether indeed loan officers were being discriminatory or being biased in their lending, or whether this was not the case. And so together with my colleague Michelle Brock at EBRD, we decided to set up an experiment to find out whether this was the case. Now the bigger picture here, before we move on to talk in more detail about the specific project, is that we observe that in many countries, but in particular in many emerging markets, women are much less likely to use all kinds of financial services, in particular form of financial services, as compared to men. And so this is no different in Turkey. And we actually see that in particular in the use of credit, the gender gap, if you will, in the use of bank credit is particularly high and also very persistent over time. We think that it's and there's also research showing this, that it's important to see whether we can close this gap, whether it's important to close this gap. Because if there is a persistent gap in the use of financial services, and if this gap is actually being caused by supply-side factors such as potential discrimination among lenders, the macroeconomic repercussions of such discrimination may be very important. So what we would observe, and what we indeed do observe in some countries, is that because women have less access to credit, their firms tend to remain smaller than they would have been in the absence of these credit constraints. And as a result, there's a misallocation of capital, there's a misallocation of human talent and human capital. And at the macro level, we see that these countries are actually growing less fast and converging less fast to the economic prosperity level that you see in richer countries. So that's sort of the bigger motivation for undertaking a study like this. But at the more micro level, of course, this was also a bank that we wanted to help to understand whether their loan officers were maybe behaving in a way that was not only unfair to some of the applicants, but also was not potentially reducing the profitability of this institution. So what we did is we basically organized a large experiment where we collected about 300 of the loan officers of this bank who were involved in SME lending. We brought them together in about 20 experimental sessions in about 8 cities. And so basically we had in a way a captive audience for a full day. And so what we did is with each of these loan officers, we gave them a pile of real-life loan applications. So these were real applications that the bank had received in the recent past, and we asked the loan officers to, using the same type of software that they usually use on a day-to-day basis, to make decisions about these loan applications. So what they had to do is to basically decide, first of all, whether they were in principle interested in lending to these people, and if so, what the loan conditionalities would have to be. Now, the only thing that we changed in these loan applications is the gender of the applicant. So we randomly decided whether we would present a particular loan application as a male or as coming from a female entrepreneur. Everything else was the same. Of course, that's a very powerful method because it really allows you to get a very well identified estimate of the presence of discrimination in a credit market like the one in Turkey that we were studying. So when we did that, when we had these people in these experimental sessions, a interesting side effect of that is that, or this interesting opportunity that presented us with, is that we could also, study these loan officers and collect a lot of information that is typically unavailable to researchers. So we asked these people a lot of questions about their age, about their work experience, what types of jobs they had been doing before they became a loan officer. But we also conducted a number of tests to see, to first of all, to measure their risk preferences, to see to what extent they were risk averse or maybe risk lovers. But very importantly, we also measured whether they were harboring any implicit biases against entrepreneurial women. And so we used a psychological tool called an implicit association test to do that. So what we had at the end of these sessions is basically for each of these loan officers a large number of applications, a large number of decisions that had been made, as well as a lot of information about the characteristics and sometimes unobservable characteristics of these people in charge of the lending process at this bank. Now, we could then start to analyze these data, and so what we found, the first interesting and potentially hopeful result was that when we asked these loan officers whether they are in principle willing to lend to these entrepreneurs or not, we did not find any evidence that they were gender biased in any way. So whether we presented one and the same file as coming from a female or from a male entrepreneur didn't have any impact in the initial willingness of loan officers to actually extend credit to these small and medium-sized enterprises. Now, what we did see is that further down the lending process, there was a more insidious form, if you will, of bias creeping in, where loan officers would actually start to pile on additional conditionalities in those cases where we presented, again, one and the same file as coming from a female business instead of a male business. And so what we saw in particular is that they were much more likely, about 26% more likely, to actually impose a guarantor requirement on those loan applications. So what this means in practice is that many women who go to branches of these banks and apply for credit, they may initially be invited to have a conversation about a loan application process, but then at the end of that conversation, they will be told that yes, the bank is willing to lend to them, provided that they can actually come up with a loan guarantor. And we know from earlier research, but we also did some research in Turkey ourselves, that a lot of female business owners do not have access to such guarantors, so friends or family members that are willing to guarantee the loan on their behalf. And for those people, it de facto becomes very difficult or impossible to actually get a loan at the bank that we were working with. The next question then that we are particularly interested in is to see why this is happening, and also whether that behavior is actually present among the loan officer population as a whole, or whether it is concentrated in certain pockets of the loan officer population. Now, to start with that last question, what we find, because we did all those measurements of those loan officers, we find that it's in particular younger and inexperienced loan officers, as well as the loan officers that are implicitly biased against female entrepreneurs, which is something we measured with those implicit association tests. In particular, those types of loan officers are less willing to lend to women, in particular if these women are applying for a loan in a non-stereotypically female industry or sector. So as long as women stay in the lane, as long as they apply for loans in sectors that are seen as typical female industries, then they are not bumping into these additional requirements. But as soon as they start to move towards sectors that are seen as more stereotypically male, then loan officers start to impose these additional guarantor requirements. Now, interestingly, when we look at the riskiness of borrowers using data from the credit registry, we actually do not see that women on average are more risky, nor are they more risky in these stereotypically male industries. And also loan officers themselves, when we ask them to rate the riskiness of these borrowers, they don't seem to be more worried about the credit risk of these female borrowers. So it really seems that some kind of stereotype is seeping into the lending process, and loan officers are imposing additional requirements just because they have some sort of a certain level of uneasiness when women apply in industries that are sort of outside of the regular type of industries that they usually apply for. Not all loan officers are doing this, but in particular these people that are implicitly biased are the ones that are actually conducting this type of behavior, and so that already suggests that this is not a rational form of screening, but that biases are really affecting the way these people are lending. So I think a very straightforward takeaway from this paper is that since experience, and in particular work experience, tends to be very important to reduce those biases, banks like the one that we work with should always make sure, in particular in conservative parts of a country, that in a team of loan officers there's always a certain amount of senior loan officers present, and so that you don't, to make sure that we don't end up with teams of loan officers that are completely made up of very inexperienced people who may be more biased in terms of the guarantor requirements that they are imposing. Let me speak very quickly about the second paper. This is basically a follow-up study where we try to evaluate the impact of a large-scale directed lending program financed by the EBRD, which was called Women in Business. And the idea of this program is to provide Turkish banks with funding to be on lend to small and medium-sized enterprises. And as part of the program, these banks were not only receiving funding, but they were also receiving a lot of technical assistance. So there was really an attempt was being made to teach banks to more productively and consistently lend to female entrepreneurs. And so what we do in this paper together with Halil Aydin from the Turkish Central Bank and Çağatay Birsan from EBRD is to analyze what the impact of a program like this is and whether you can really durably entice banks to lend more to female entrepreneurs and overcome the constraints that I've just been talking about that we observe in the first paper. And some of the results, we're still working on this paper, but some of these results are quite hopeful in the sense that we see that once you give banks not only additional funding but also additional know-how, it is actually possible to durably push these banks to do more lending, in particular in parts of the country, in this case Turkey, where lending to women is less common. And we also see that it's interesting to see that they not only do this by lending more to existing clients, they also try to poach clients from other banks, and they also try to really draw in new first-time borrowers that so far have never been able to borrow before. So we really see that sort of financial inclusion at the extensive margin is really being expanded, and new borrowers emerge, and they continue to be safe borrowers as well. So using directed lending programs like this may also be a good way to sort of counterbalance some of these tendencies among at least certain parts of the loan officer population to not lend to female entrepreneurs.